Welcome back to another portfolio update, the first of 2025. So as always, a quick update of what has happened or has not happened with the couch investing portfolio. And then let's touch on the FOMO aspect, fear of missing out. Now, right now, as you can see, since we started this portfolio, we're up 63.22% compared to the S&P 500, which is up 19.16% in the same period, which of course is great. Huge outperformance by the portfolio. And yes, it's true that the outperformance did start quite late last year. But okay, I don't mind. Right now, at the time of making this video, I have 14.29% in cash. If you're new here and you don't know how I got so much cash right now, it's basically because I completely sold out of Palantir stock. Still believe in the company. I just think that the valuation is extremely overstretched. But okay, that did not stop the stock from going up another 10% or so. Also took some profits from Tesla, and so that's why the cash position is the biggest position in the portfolio at the moment. Now, I did add an extra company. Well, I had that company before for an earnings trade, didn't work out, but then a couple of days later, I just added back in, and that's Micron. If you've been following the channel, you know that I am quite bullish on Micron, and to be honest, didn't make sense for it to go down so much. Yes, it's true that guidance for next quarter did miss by $1 billion, but I do think that the stock already took a major hit. So a couple of days after that, I decided to add it back in. You might say, oh, but you had it, you sold, and then you bought back in. How does that make any sense? Well, I said it was an earnings trade, and if I say it's an earnings trade, then I have to stick to the plan. Because if I start changing my mind left, right, and center, there's no discipline. So I did it. I also don't have any capital gains taxes, so I can do these types of things. If I did have, then maybe the plan, the strategy would have been a little bit different. So I added Micron. That's basically the latest company that I added to the portfolio. I added Micron, only 50 shares at the moment. I'm already up 10%, but that's I think because Micron is up today 11%. So okay, great timing. But if you look at when I bought and sold last time, I sold at an 11.85% loss. I basically bought it at the same price I sold it before. So yeah, okay, we're back in Micron, small position. I expect it to grow over time. All in all, if you're new here, these are basically the positions in the portfolio at the moment. Number one is cash. Then we've got SoFi, PayPal, Google Alphabet, Tesla, which, I mean, we're still up quite a lot on those companies. Rocket Lab, number 6, up 587%. But yeah, there's no point to me selling because it was an extremely small position. I don't want to sell any shares. If it goes back down by 50%, I don't really care that much. Then we have number 7, Intel. I'm down 20% on that. dLocal up 15.5%. Uber already up 5.5%. Uber is up today because they have announced an accelerated stock buyback program of $1.5 billion. They see their stock as undervalued. I mean, I agree. That's why Uber has become a rather large position quite quickly in this portfolio. Then we've got Alibaba. The Chinese plays are basically Alibaba and Pinduoduo. Of course, I'm already down on both of those stocks, not by much, but okay, those are the contrarian trades for this year. Then we've got Meta, Transmedics. Transmedics is also up and in the green today, so that's already great. Micron, Celsius. Celsius continues to outperform, and that's probably the worst stock right now, down 33.8% for me. Then we've got the super small holdings here. Upsellera down 15.12%. and Owlet up 6.42%. Those are basically stocks where if it goes to zero, then fine, goes to zero. It will have very minimal impact on the overall performance of the portfolio. But if it does 2x, 3x, 5x, 10x, then yeah, it's going to be quite a lot of profits to add, probably to the cash position. Now, that said, I did add a couple of companies to the watch list, and I do intend to add some of those in the portfolio also as some shorter term positions. Shorter term for me, in this case, is going to be probably in the next 12 months or so, because I do think that there is a disconnect. We talked about Viking Therapeutics on the channel already. It's a high risk, high reward type of company. It either works out or it doesn't. Still don't generate any revenue. So the only catalyst that we should expect, acquisition target, and well, results from trials. Phase 2, phase 3 results. stuff like that, that should move the stock. So high risk, high reward. Then we've got Lyft. I think there's a huge disconnect there. I know some people already hate Uber because, well, autonomous vehicles like Tesla and Waymo and all of that will destroy their business. So why even bother with Lyft since Uber is already beating them by being Uber? I agree, which is why I already have Uber, but I still think that Lyft, despite the dominance of Uber, despite Waymo taking a lot of market share in San Francisco, we've seen that Lyft's business fundamentally does become better and better. So again, there is a disconnect there. I might take advantage of that. There are still some stocks, yes, even in an overvalued, overstretched market, there are still some stocks that are worth buying. Then, a very, very interesting company that I was made aware of last week is Nebius Group. Nebius Group is a company, well, I'll have to do a completely separate video about that. It's the ex-people from Yandex, the Google of Russia. They had to spin off their business, etc., etc. It's a small, big AI company that is, well, expected to grow quite quickly. Very, very close ties with NVIDIA as well. So it's on the list here. We're going to touch on that in a separate video because I do think that there is quite an opportunity there. Then the last one, and this is something I recently added, and that's Snapchat. Also at $12 current valuation, they're expected to grow earnings by 50%, over 50% in the next 2 fiscal years. Now, it's already a company worth $20 billion. It's not an $80 or a $90 billion company like it was back in 2021. But here as well, although I always said I don't like Snapchat, it has proven me wrong from a business perspective. It has turned itself around a little bit, slowly but surely, but its user base continues to grow. And if a user base continues to grow and you're reaching 500 million users, then you're going to attract quite a lot of advertising dollars, regardless of whether or not I think this app is garbage or not. If there are users, if people use it, then advertising dollars will flow in. We will also see, I'll do a separate video on that. We'll also see that, well, from a business perspective, they're doing better. Profitability wise, for sure, they're doing better. So here as well, there might be a disconnect. Do I intend to hold these types of companies for 10 years? No, like I said, it's probably a play for 2025, maybe 2026. But yeah, that's about it. So now that we've done the portfolio recap review, whatever you want to call it, let's talk about the current, well, FOMO, fear of missing out. Because we do talk a lot about specific companies on this channel. We do talk a lot about undervalued companies, companies with disconnects like we've just seen with Lyft and Snapchat. So maybe I might be contradicting myself because when we look at stocks, we always look at, what's the potential upside, right? We're looking at the disconnect. Maybe the stock is doing horribly, like we've seen with SoFi back in 2024 for the large part of the year, even 2023. The business continues to go well, but the stock does not move and actually goes down. So there is a disconnect, there is an opportunity there. So we acquire more shares because we also like the business. Then there is this aspect of fear of missing out. When we see a lot of other stocks go up 50, 100, 200, 1,000%, like we've seen with some AI stocks, like we've seen with some quantum computing stocks, we have a thing called fear of missing out. Then we start buying left, right, and center because we think, if this goes up, I have a group of stocks that have not gone up as much as the others, so I have to participate in this movement right now. So let me throw some money here and there. Now, it might be a good tactic for a trader, especially when there is, extreme bullishness in the market, when there is momentum in the market, then it does work out, as we've clearly seen with some quantum computing stocks. But when we start looking at some solid companies, right? When we start looking at companies like AMD, for example, stock has gone down quite a lot from some pricing metrics, valuation-wise, it does look cheap, right? So the upside, let's say, is 50%. But then you look at other stocks you might also own, because in this case, AMD you do not own, but everybody's talking about that. Stock is down, it's cheap, AI, GPU growth, revenue, etc., etc. All of that is expected to grow. Let's call it 50% upside. I'm just throwing the numbers in the air right now just for the sake of the argument here. It's not 50% upside. I don't have a crystal ball. But when you own a certain stock and then you see at another stock that has fallen and people are saying it's extremely undervalued, analyst price targets are much higher than the price we're at right now, etc., etc., then you're like, oh, maybe I should be buying that stock because it might go up 50%. So that's the fear of missing out. But then you forget that you might own stocks that are maybe already quite big in your portfolio, but might also still be undervalued, might also still provide you with significant upside. So we are now in this type of environment where, yeah, a lot of your stocks are probably up by quite a lot. I'll take PayPal, for example. PayPal is up, 50%, 40 something percent in the last year or so. Does that mean that we don't have another 50% upside in the next 12 months or so? No, I'm not saying that. I think there is still upside ahead. Does that mean that I suddenly have to go and buy other stocks because those other stocks I do not own, but they might also provide me with some upside and have gone down 30% instead of going up 40%? No, in my opinion, not. I mean, okay, you might be adding great companies like AMD. You add great companies to your portfolio and you get upside. But if you're purely looking for the upside, then why not add to your existing positions, right? Why am I talking here about Lyft, Snapchat, and those types of companies if I can still add to companies like PayPal in my portfolio, like Uber, maybe even Alphabet, right? Maybe I might buy Nu. I don't own Nu anymore, but maybe I might buy it because, well, it has come down very, very much undervalued, mispriced as well. But here as well, we are now in an environment where everything is bullish, everything goes up. We've talked about Cerence, right? That stock has gone up 150% because they released a press release that they are collaborating with NVIDIA, although we already knew that they worked with NVIDIA before. But hey, the state of the market right now is quite strange, so these things go up by 150%. Fine. So the main point here is that fear of missing out does not make much sense, especially not right now, because I'm sure that a lot of you do own great companies in your portfolio, even companies that have gone up 50%, maybe even more, and can still provide you with significant upside in the future. Yes, it's true, there are some companies that are quite expensive, and maybe now is not the moment to add to those, maybe now is the moment to add to others. Yeah, then that makes sense to look for the Ubers, for the NVIDIAs, for the Lyft, the Snapchat, and all those types of companies. Yes, that does make sense. But beware of the fear of missing out aspect in this market, because the grass is not always greener elsewhere. No, maybe your grass is perfectly fine. So all in all, that's about it for this week's video. If you enjoy this type of videos, leave it a thumbs up, subscribe if not, and I'll see you all in the next one. Bye bye.